Hello everyone, I am Sandip Agarwal. Welcome to my YouTube channel, Financial Markets by CS Sandip Agarwal. This is the fourth and final video under the options advanced series, and in totality, this is the 16th video under the option series. So with this video, we will conclude the entire series on learning about the options. I hope you have liked my content on the options. In case you are liking the content, please do like and subscribe to my channel so that you can get notifications about any future videos which would be uploaded in future. Also, in case you feel that my videos are adding value to you, so please feel free to share my YouTube channel link and the videos link with your friends and family. Till video number 1 to 15, we have explained various concepts in theory as well as with the help of the practical examples. Now, in this last 16 video, I will share with you one practical strategy which can be applied on any expiry day for the Nifty and Bank Nifty, either weekly expiry or monthly expiry. Please note that whatever I'm going to share in these videos are not trade recommendations, and I'm not recommending anyone to enter trades basis this video, but this is just for the learning purpose only. So let's start. So before we start these videos, in this video, I will first of all explain you these three additional concepts which will help you to understand the practical strategy which I have shared in this video. One of the concept is called VWAP. VWAP stands for volume weighted average price. Second is volume, and third is price action. So with the help of this three additional concepts and the existing concept which we have learned in the previous 15 videos, I will explain you one strategy which can be applied. So what is VWAP and volume? So VWAP basically stands for volume weighted average price. Now let's say for an example, the market opens at 9:15. Now say during first 5 minutes uh, after market opening, there are around 200 transactions or orders which happened at different price in either Nifty futures or in any particular strike price of the call or put of Nifty. So what would be the VWAP in this case? So VWAP will be the sum value of all the transactions which happened in the first 5 minutes divided by the total volume which happened in the first 5 minutes. So that is called as a VWAP. So that VWAP will be treated as the price for the first 5 minutes. And what would be the volume? Volume will be the sum total of all the volumes which happened during the first 5 minutes. So in our case, there were two transactions will happen. Now say in those two transactions, there were 1000 Nifty futures which exchange hands. So the volume will be 1000 lots. And depending on the price at which those 1000 lots traded, divided by the 1000 volume. So that price will be treated as the VWAP, which is volume weighted average price. So in this slide, we basically understood what is VWAP and volume. Now in the next slide, we will understand what is price action. So uh, this is basically called a candle. So this is a price action. So in the market, it is known as a candle stick, a price pattern. Now, whenever the color of the candle is green, it is considered as a bullish candle, whereas whenever the color of the candle is red, it is considered as red candle. Now, how do we interpret the green candle? So, this line where I'm pointing out the laser is treated as the open price. This is considered as the low. This is considered as the high price, and this is considered as the close price. Now, if we consider the example in the previous slide, where I have taken the example of the first 5 minutes of the volume and price action, that is when the market opens at 9:15. So I have considered that in the first 5 minutes, whatever transactions are happening, the average price of those transactions is considered as a VWAP. Now, let's say this candle stick, which is the price action, is for the 5 minutes, first 5 minutes. So it means that during those first 5 minutes, The market opened at this price. It went low till this price. It went high till this price. And at the end of 5 minutes, it finally ended at this price. Similarly, in the case of the red candle, it is interpreted as that the market at 9:15 opened at this price. It went high till this price. It went low till this price during that 5 minutes itself, and at the end of 5 minutes is finally closed at this price. So these three concepts which we have understood, volume, VWAP and price action, we will understand it with the help of a practical example, which is also can be considered as a strategy, and we will also apply certain concepts on the options which we have also learned. Now see, the strategy which I am going to discuss in this video is basically buying a call or a put option. Now, in my various videos, I have given you the concepts about the buying of the options, the selling of the options, the various bullish and the bearish strategy, as well as this non-directional strategies as well. In this video, I'm going to share the example only on the buying of the option. Now, I have taken the expiry of the 23rd June. This was a weekly expiry. As I explained in my earlier videos, there are 3 or 4 weekly expiries in a month and a monthly expiry as well. So this is the weekly expiry of the 23rd June. At the end of the 23rd June, the Nifty ended somewhere around 15,572. I have basically taken a 5-minute chart of 15,500 call option for the 23rd June expiry on the 23rd June itself. Now, how do we apply this buying call option strategy? Now you see this dotted line, which you can see, this dotted line is around at 9:19 p.m. in the AM in the morning. That is first 5 minutes of the price action post the opening of the market. This blue line, which you can see, is basically the VWAP, and this each of the candle is basically the price action of the 5 minutes. This colored volume, which you can see in red and green, is basically the volumes which has basically happened in 15,500 strike price in each of the 5 minutes. And this red line, which you can see, is basically the open interest in this 15,500 strike price. Now, if we recall the concept on the open interest, so one open interest, for each open interest, there will be a buyer as well as a seller. We have to consider the open interest always from the perspective of the option seller. Why? Because the margin in case of the option selling is much higher as compared to the option buying. So the option seller are treated as the strong hands in the market. So we will interpret this option interest from the perspective of the option seller. Now, how this strategy of buying option works? So whenever the closing of this price action candlestick for 5 minutes ends at a price which is higher than the VWAP. Now, in this case, if you see, the VWAP was around 39 rupees, whereas the price ended somewhere around 42, 43 rupees. This is a screenshot which I have taken from a website. That's why you may see a gap of 1 or 2 rupees, but you just understand what I'm trying to say. So this price ended somewhere at around 43 and this VWAP was around 39. So the price, the closing price of the first 5 minutes of the candle ended at a price which is higher than the VWAP. Okay. Second, if you see, the volume for the first 5 minutes was much higher as compared to the previous 4, 5, each of the 5 minutes price action. Third, if you see, there is a continuous reduction in the open interest. The line which denotes the open interest outstanding is continuously sloping on the downward side. So whenever these three conditions are meeting, that is, one, the current price at the end of the 5 minute candle ends at a price which is above the VWAP. Second, it is being accompanied by a higher volume as compared to the 3, 4 earlier 5 minutes price action. And third, there is a decline in the open interest. So what does it mean? That the price basically ended at, at above the volume weighted average price. Second, it was accompanied by the higher volume. That means some strong hands has entered in the market. And third, the people who have sold this 15,500 call option are not confident. They are fearing that the market may move upwards and they may have a negative MTM. They may incur a loss. So that's why they are unwinding their position and they are running. So whenever these three condition meets, the people can go, they can buy this call option. So at this point of time, when this candle ended, the price was somewhere around 46, and they can enter at the 46 price and they can keep a stop loss at the low of this candle, which was around 22. So the person entered at around 46, the stop loss is around 22. So the net stop loss would be 24 points. Now one lot of Nifty call option is 50 quantity. So 50 multiplied by 24, so that would be a loss of around 1200 rupees. Now say if a person has ended one lot of call option at 15,500 at 46 with the stop loss of 22. So in that case, the stop loss for that trade would have been 1200 rupees. Now, how do we trail this position, or how do we know that this position needs to be exited? Now, once you have entered, you can trail the stop loss as the low of the previous bullish candle. Now, once you have entered the trade at this point of time, you see in the next candle, the price again went up to 60. And now when this candle gets over, you can modify the stop loss from 24 to the low of this candle, which would be around 47. Now you can see there are continuous 4-5 bullish candles, and the low of each of this bullish candle has not gone below the low of the previous candle. You can just see. Now this is again the bullish candle. Now your stop loss, revised stop loss, becomes the low of this bullish candle, which is around 90. Now again you can see in the next 4-5 candles as well, the price has not breached the low of the previous candle. Now finally, if you see, this is the bullish candle. Now this bullish candle, now again the bullish candle is also over here. You can see the low of this previous bullish candle has also not been breached over here. It finally got breached in this candle. So the low of this candle was around 110. Now finally, the trade which you entered originally at 46 with a stop loss of 24, finally you got exited at around 110. Now with the initial stop loss of only 24 points, you got somewhere around 64 points. Now on one per lot of this call option, where your initial risk at stake was 1200 rupees, you got around 64 points, which is multiplied by 50 comes to around 3200 rupees. Now you see, the moment the price ends at a price which is less than the VWAP. Now you see at what is the time where the price breached the VWAP and closed below the VWAP? It was around 1140, 1145. Now immediately at that point of time, you can open the chart of the in the money put option of the same strike price. Now in the next slide, you see I have opened the chart of 15,600 put strike price for the 23rd June expiry for the 23rd June date. You can see this is the time at 11:49, and the price ended below the VWAP at around what? Around 11:40, 11:45 times. Now we see again whether these three conditions which got complied in the previous slide are also matching in this one or what. First, the price The closing price of this 5 minutes price action ends at a price which is higher than the VWAP. It is accompanied by a very high volume as compared to the previous 5 minutes price action. Third, there is a downward sloping in the open interest, means the people who were writing the 15,600 put option are not so confident. They are fearing that the market may go downwards and they may have a loss. So that's why they are unwinding this position. Now the person can again enter this position at a price of around, it was around 65 rupees, and they can keep a stop loss at the low of this price, which is around 45. So the loss, so initial loss would be around 20 points, multiplied by 50 will be 1000 points. And you can again keep on trailing the position as the low of the previous candle. And you can, low of the previous bullish candle, you can see none of the lows of the consecutive candles has breached the lows of the previous candle. Till which candle? Till this candle. So the low of this candle was around 184, which got breached over here. Now, once your low of the previous bullish candle gets breached at 184, so there will be very quick price action. It may so happen that you may have exited at 180. Now you see the initially the trade which you entered at 65 with a stop loss of 45, only 20 points, you finally got exited at 180. Now from 65 to 180, which is 115 points. Now the initial risk was only 20 points, which is 1000 points, whereas you got 115 points, that is multiplied with 50 comes to 5750. So you almost got a risk to reward of 1:6. So that's it from my side. So I hope you have liked the content in these videos. Thank you everyone. So with this video, I conclude the entire learning series on the options. So in the next 2 to 3 weeks or maybe a one month, I will again start a video series on a new topic related to the financial markets, which will add value to you. Thank you.